Hey you guys, today we are looking on the eve of the next congressional hearing. We already saw GME and as well as by proxy AMC get talked about in the House of Representatives in America. We also saw them get talked about in the Senate. We haven't seen a ton of progress. However, this time around it may just be different. We have the testimonies of these guys right here, and I want to make sure that we cover a couple of the highlights of these testimonies so that you can fully understand what to expect tomorrow. We will be live streaming all day tomorrow, and I want you guys to focus up because we have Michael Blaugrund, the COO of the New York Stock Exchange. So we're looking to see what kind of policy questions he's going to ask, as well as what kind of market questions he's going to expect it to be answering. We also have the Vicky L. Bogan. She is a professor at the University of Cornell, kind of like how Meatball is a professor at the University of Cornell. And then we have a senior policy analyst. Hold on a second. This is Alexis Goldstein, who is an analyst in the Americans for Financial Reform. And then finally, we have Sal Arnook, who is the co-founder of Themis Trading, with his partner Joe Saluzzi. So there you go. We want to be able to focus up first on the COO of the New York Stock Exchange. And as we are waiting, we are checking around to see if Trades is going to join us in just a sec. So don't go anywhere and follow closely. So Chairwoman Waters, Ranking Member McHenry, blah, blah, blah. This is very much like Vlad's and Keith Gill and Mr. Plotkin. And Mr. Melvin's, Mr. Melvin is Mr. Plotkin, so Mr. Kenny G's testimonies a couple of weeks ago. This is Michael Blaugrund, and they are the COO of the New York Stock Exchange. The New York Exchange is the world's largest exchange, NYSE listed companies employing more than 43 million people worldwide. Okay, they have their purpose to help people, and then they play a central role in the capital markets. And that being said, now we get to the juicy part. The events of January 2021, where the first gamma squeeze for GME and AMC started, raised valid questions as to what, if anything, policymakers should seek to reform in the equity markets regulatory regime. The Securities and Exchange Commission, SEC, has announced that it will study these events as it has studied others in the past, and Acting Chair Lee has gone on record to recommend that the Commission will, prior to the completion of that study, lead with a regulatory action in a few areas, including, and here is the big kicker, what kind of regulations are they going to follow? We are looking at retail investor suitability, enhanced short selling disclosures, and a review of the relationship between payment for order flow practices and best execution obligations. Too fast or not too fast enough? Well, you know for a fact that these Congress people are not technical in finances or technology. If you guys remember from the last time we talked about what is a stock market, what is a short, what is a long position, we will follow with you shortly. Whatever conclusions the regulators reach about what ought or ought not to be done, a key principle must hold true, that public policy should build investor confidence in the markets. Could not agree more. If policy is not here to tell people what not to do, it's to tell people, hey, no matter what you do, the markets are going to keep you safe and keep your money safe, most importantly. So, investor confidence is built when individuals are armed with accurate information. Data is king about public companies, when infrastructure operates with stability and resiliency, when markets function according to predetermined rules, and when regulations are vigorously enforced. The SEC's study will inform policy development, but the NYSE believes at least 4 areas merit consideration for regulatory reform. Follow closely. These are the 4. First, modernizing shareholder disclosures, right? We got section 13F. If you guys have not yet heard about 13F, it is part of the Securities Act's amendments of 1975. And generally, it let's put it simply, luckily he does, investment managers with at least $100 million in equity exchanges holding must file quarterly reports on the Form 13F detailing their long positions in equities and listed options. Essentially, this is a 4 times a year, tell me what kind of positions do you have, you show me yours, I'll show you mine, and then everybody with purse strings and liabilities and risks in the game game will be able to understand exactly what they're up against. These reports are due within 45 days of the end of the calendar quarter and are designed to provide the commission, issuers, and the investing public with information to make more informed decisions about how to regulate, engage with shareholders, and invest in public companies. Now that is kind of insanity, that they are due within 45 days. 45 days is already half a quarter. And I went to the University of Chicago, so we had a quarter system. Can you imagine if the final assignment was due next quarter, 5th week of the quarter after the quarter that you are currently in? Anyway, it seems a little loosey-goosey. At the NYSE, we sit at the nexus of issuers and investors, and both groups have strong feelings about 13F disclosures, right? So let's see exactly which one he is trying to push. He's trying to push for 13F disclosures, more vigorous 13F disclosures, or less rigorous 13F disclosures. Corporate issuers feel that current limited frequency and lengthy lag time is preventing them from engaging productively and efficiently with their investor base. By contrast, institutional investors are concerned that more frequent or timely disclosures would erode the value of their fundamental research by allowing other investors to free ride off of their investment decisions, particularly if they have not yet fully established their intended position in a given security at the time of their 13F disclosure. So essentially, he's just trying to say both sides of the story right now. One side says if you have a quarter and a half to tell us exactly what you did last quarter, that sounds like a lot of time, a lot of lag time, and it's not going to make it very clear where everybody's positions are. Isn't the point of this rule to make it clear that everybody shows theirs and we know where everyone else's long positions are? In contrast, some people think, well, our positions are secret for a reason. We like to keep it hush hush because we have a specific strategic advantage. Otherwise, what's the free market doing here, right? It's just going to be too much disclosure, too much data around. And I say, you guys probably can guess what I think about this. I say that too much data is never a thing. We have facilitated joint discussions with representatives of both of these groups in hopes of identifying a constructive middle ground. Based on this dialogue, we believe the SEC should consider shortening the delay from 45 days after the quarter. So shortening the delay, who knows how much shorter, but they don't think half a quarter later makes any sense. Additionally, because issuers have a special interest in knowing who their owners are, the SEC should consider mechanisms to complement the public 13F filing process that enable direct disclosures to corporate issuers when a reportable position is established or fully divested. Potential information disparities could be addressed by leveraging blackout periods for corporate issuers when they choose to access the information. There you go. So right now, it seems like they want faster. Did Trey just message me? No, he did not. Thought he did. Essentially, they just want to get this information out faster, and otherwise they can see how both sides would want this one to be more rigorous in terms of reporting more frequently or more timely, and the other side saying that if I report more timely, you guys are gonna know my secrets before I have an opportunity to make some money off of them, right? Kind of like the copyright idea. We copyright things because we want to make some money off of them before we die of old age, which is why the copyright length is a certain amount of time. Providing transparency for securities lending. So this is number 2, right? This is what Mr. COO of the New York Stock Exchange thinks. Short selling is an essential practice for liquidity, price discovery, and risk management. So they thinks that short selling is super duper important. Well, a couple of people that have been experts on the situation, like Renzel, think that, in an ideal world, short selling would not exist, and therefore this kind of situation would never happen again. The securities lending market on which it depends is opaque and inefficient. So he thinks that short selling is awesome, but unfortunately it doesn't show enough data to the people that want to see. Like, where are all these shorts? Why are some of them counterfeit? Why are some of those counterfeit shorts completely legal? These are the questions we're going to answer here. Indeed, research from the Department of Treasury's Office of Financial Research has identified the potential for systemic stability risks associated with securities lending. FINRA collects equity short position information from its firms twice a month, and that's the FINRA report that we check out every single 2-week cycle. And that's why you guys are chilling with us whenever we go and look for the FINRA report. FINRA collects, This aggregate data is insufficient for market participants or regulators to understand how supply and demand are changing for stock loans in an actionable fashion. Interesting. So they think that this is finally too little too late every time we have to wait for not only a delay, but also a delay on the daily, a delay on the reporting window, and finally a delay in the sense that we don't know how much of the short still remains to be covered. Why don't we know this? We're just guessing here, and that's maybe going to be a thing of the past in the future. So there you go. Okay. So by contrast, for decades, investors have benefited from the real-time reporting of trades and quotes for securities transactions on the consolidated tape for the equities market. The consolidated tape provides a simple, low-cost mechanism for investors and issuers to understand the prevailing market dynamics for securities trading. The SEC should consider establishing an analogous consolidated tape for securities lending. Excuse me. A system that provided for publishing the quantity, fees, and or rebates, duration, and other material terms for each stock loan without attribution would provide issuers, investors, and regulators the necessary data to better assess the risk and return of establishing a short position while protecting the identity and intellectual property of any individual market participant. As a minimum, stock loan information should be collected by the commission and considered for the public dissemination in the future. So right now, he is essentially saying we're not trying to break the system right now. We know that FINRA has been doing this twice a week thing, but we already have a vehicle that we can directly map onto this system, right? If we already do it for this completely separate thing, how about we try it with this thing? It's essentially saying here is a policy suggestion that already has a template, and we don't want to be able to rock the boat too hard, otherwise you'll never think about doing it. Section 984 of the Dodd-Frank Act provides a sensible framework for the SEC to tackle the issue of stock lending transparency. 984B of Dodd-Frank directed the SEC not later than 2 years from the date of enactment to promulgate rules that are designed to increase the transparency of information available to brokers, dealers, and investors with respect to the loan or borrowing of stocks. Let's say that this is just a bunch more mumble jumble to say, hey, we are trying to make it clear that people have rights to understand what this current situation is with these shorts, right? Otherwise, how does anybody know what everyone else is doing on a timely basis? Because we keep talking about the fundamentals of the short squeeze and the gamma squeeze. So that only works if people understand what the public call the option chain is for the gamma squeeze and how many shorts have yet to be covered for the short squeeze. This is very important to be able to hear it out of the NYSE COO's mouth that he wants more transparency as well. Eliminating competitive barriers for public investors. Almost done. 3 out of 4. Transparent public markets are critical to the success of the U.S. equity markets. Exchange quotations drive price discovery, and market participants bid at higher prices and offer to sell at lower prices when they have a reasonable expectation that their displayed price will attract a broad range of investors with different investment time horizons. Okay, pretty clear so far. Because it is typically uncorrelated with other asset prices and held for the long term, self-directed retail order flow represents one of the most sought-after classes of trading counterparty. Over the past year, retail flow has also been the fastest growing segment of the market. It is encouraging to see increase in broadening participation in investing, as public markets are a powerful mechanism for democratizing participation in economic growth and reducing economic inequality. Okay? The vast majority of self-directed retail order flow, however, never makes it to the public market. Instead, retail orders are typically routed to a broker-dealer wholesaler for internalization, a process that guarantees an execution to the retail customer in exchange for granting the wholesaler an opportunity to trade with the order before other market participants. Internalization is beneficial to the individual retail investor if the execution results in meaningful price improvement relative to the public market, which it often does. However, internalization deprives investors in the public markets the opportunity to interact with the orders, resulting in inaccessible liquidity for large institutional investors. So right now, we are essentially saying that there is too many middlemen along the way, right? Why is there this broker-dealer wholesaler in the middle? Is it supposed to be for the original reason, which is it helps the liquid of the market flow to greater and greater, or is it actually becoming little pieces of sand in the market instead, stopping the gears from turning properly? The problem with this right now is essentially saying that too few people actually have perfect, transparent access to the market. Right? Usually you guys have the process down to a T. Some of you who have just started investing right now with either Robinhood or Webull or with a easy trade like on Fidelity or TD Ameritrade, those of you who have instant satisfaction of conducting a trade with a broker that charges you absolutely nothing, well, one of the things about that is it's still only a piece of the entire market that you can access, and sometimes you can't access at all. That said, if you're afraid that your broker is going to restrict your access again, I do recommend using the link in the description down below to get yourself a Webull app. That's the technical app that I'm using. I'm looking at the price of GameStop after hours and AMC as well on the exact same chart. A data scientist uses this specific app, and I recommend it for anyone else who is looking. Also, you get 2 free apps, which is also a small bonus. If you aren't planning on using Webull at all, that's okay, because at the very least you have the opportunity to use it, and that is something that will be helpful if you've already funded it and the squeeze is happening and you don't know what to do. It helps that you aren't all in on one trader. Under today's regulatory framework, the proportion of trading on public exchanges is at an all-time low. In fact, at the end of the year, on some days, some more shares were executed in private, dark venues than on lit public exchanges with displayed price discovery. Let's see. Trading in securities with a higher level of retail participation may have 60 to 70% of their shares traded in the dark, just not enough transparency. Investors trading on public exchanges, including the NYSE, have a limited ability to compete for much of the retail volume executed by wholesalers. In large part, this is due to the difference in the regulatory framework for broker-dealers and exchanges. For example, why, before, you don't even have to give me an example. Why exactly is it so easy for certain institutions and wholesalers to do things that retail investors can't? This doesn't seem like a fair and equitable market just because you think that there's some asynchronous rules. You think that a synthetic long or a synthetic short is a viable solution to change the market, essentially the access of the market to some and increase their access to others. In my opinion, that is pretty darn suspicious. For example, unlike exchanges, wholesalers can offer privately negotiated terms for price improvement or payment for order flow, choose to interact only with a curated set of market participants, and accommodate clients in cases where there may be a dispute. However, investors trading on exchanges are also on unequal footing in a more straightforward way. Off-exchange trading is permitted at price increments as small as 0.0001 cent, right? That's a hundredth of a cent, while investors can only trade on the actual cent. So if you guys have noticed in your Webull accounts, you have a volume analysis and time and sale analysis. You are able to know exactly when a bot is the one trading, right? Because they are going to be trading at a much lower and more granular level. So if regular retail investor is not able to trade, like for example, I'm not able to trade at a 0.0001 level, so therefore that can be an immediate tip-off of this price increment. NYSE research has recently demonstrated that 30% of market volume is artificially constrained by this penny-wide regulatory requirement. This results in an inefficient price discovery that makes it more difficult for public institutional investors to access the full liquidity of the market. Essentially, this is just being admitting that much of this market is rigged. Is that there's no way that these two people can find each other. The seller who wants a specific price increment as small as this, and someone who can only make a specific price increment as small as this, right? 30% of the market volume is artificially constrained. That's huge. The NYSE believes that it is time to harmonize on the on and off exchange price increment regimes. From a public policy perspective, if sub-penny trading is allowed in private dark trading, we believe similar conventions should also be allowed on public lit exchanges. Reducing the minimum pricing increment on exchanges in active low-price securities would lower investor trading costs, improve market transparency, and provide an increased opportunity for investors trading on exchanges to interact with retail orders. So sub penny trading. He no longer thinks that that makes any sense. And dark trading. This is just preventing normal investors like you and me from accessing the market, up to 30% being artificially constrained in this way. Finally, you guys are still with us. This is the final page. Accelerating trade settlement to T+1. This is huge. They've been talking about this for a long time. If you guys aren't aware, it doesn't take your stock the 5 seconds or maybe the 1 second you think it takes when the confetti on your Robinhood account goes, woo, you bought a stock. Actually, it takes T+2, at least 2 days from the initial purchase before they take money out of your account and then give you that stock. Why? I don't know. No, the actual answer is that they want to make sure that both parties have the whatever that they are trying to say. I have the money, you have the stock. Well, I want to make sure that you actually have that, and we'll take 2 days to actually clear it. That is unnecessary. And people have been talking about T+1 or even T+0 as an immediately settle these transaction like at the place of purchase, which is exactly how everything else is done. Why doesn't the stock market run the same way? Ask yourself these questions next time. However, right now it seems that the NYSE is supporting the growing consensus to accelerate industry settlement cycles from 2 days to 1 day after the trade. Though a shorter settlement cycle increases the potential for an operational error, the capital efficiency to be achieved by the industry is likely worth the risk. According to the DTCC, netting trades and payments for intraday activity reduces the value of payments needed to be exchanged by an average of 98% each day. Without intraday netting, massive capital inefficiency would reduce and inhibit the liquidity retail and institutional investors depend upon to buy or sell with immediacy. Future innovations, including any possible acceleration to real-time or T+0 settlement, should preserve the benefits of transaction netting currently enjoyed by the industry. So he's even talking about real-time or T+0. Like at that day, you're going to have to settle that transaction right away. So that is something that's very important to note, is that he is the COO of the New York Stock Exchange, and he's saying, yeah, this stuff can be in the future. Right now, we're just asking for a small thing. Just please change it from 2 days to 1 day. We only want 1 day, and the reason why is that when your clearing firm allows your broker, like Robinhood or Webull, to buy stocks for you and your behalf, then that Webull or Robinhood needs to put up a ton of money depending on the risk it takes to buy a stock. That's why when the clearing firm said to Robinhood that it's going to cost like a ridiculous amount of money to hedge the bet that maybe some of you don't have the money to buy that stock, Robinhood restricted buying, because only on buying is there collateral that Robinhood needs to put down for those clearing houses. We believe that free enterprise is the greatest force in history to improve the human condition. NYSE listed companies are blah blah blah. Smarter regulation of today's equity market structure will improve investor confidence, encourage entrepreneurs to access the capital markets, and allow the US to extend its leadership in the global markets. And that is the end of his 4-page testimony. You guys know that there's more testimony. I'm going to link those other ones here, such as the ones by Cornell University professor. There's 7 pages of that. We also have the 10-pager of this American for Financial Reforms, and finally we have the Themis trading. This is another 9-pager, but there's pictures about gamification specifically. So once again, I ask you guys, does this sound like they are on the right path? Even the NYSE is advocating for very radical changes in small increments. They understand exactly where we need to go, and they're trying to make it clear that they're willing to go there. If you guys like this video, or you think that you wanted to be able to show off your own thoughts, I want you guys to see some comments down below, as well as hitting that like button so that more apes can find this video. So hope you guys have a really, really cool day, and now off to Trey.